Welcome, everyone, to this rhythmic deep dive.
Where the source facts and insights are always alive.
We're tackling finance with a metronome beat,
Yep.
exploring the market from its head to its feet.
Our mission is pretty clear, our focus quite true.
We're here analyzing metrics and risks just for you,
We'll also cover taxation and how funds are designed.
basically covering all the details for your peace of mind.
Okay, so where should we start?
Well, let's unpack this and start with a measure. I think it's a foundational tool that's a true market treasure.
You're talking about the PE ratio.
I am. The PE ratio, a prime valuation score. It's how investors assess what a company is worth and, and then more.
Exactly. PE is the price divided by earnings per share,
Right.
showing the years needed to recover the capital you laid bare.
So in theory, then, if a PE sits precisely at 20, it means it takes 2 decades to earn back that plenty.
But, PE is not just a calculation, plain and quite neat.
Oh, not at all.
It measures market emotion from Wall Street's Main Street. It really does. A PE that is low, for example, often signals deep fear.
Or possibly value that is finally near.
Right. And on the flip side, a high multiple means high expectation is flown.
Where the market believes great growth will be shown.
Exactly. Investors are paying for futures that seem bright.
Banking on gains that are certain and right.
But that distinction is, well, it's so key. The danger is true.
So how do we distinguish the old from the new?
Yeah, how do you tell?
How do we tell if we've found a great steal or if that low number conceals something, real?
Well, a low PE can occur for reasons we see, like a struggling industry or one that might flee.
A value trap,
It could be a value trap that has captured some pain, meaning the earnings will likely not gain.
which means you can never look at the number alone.
Never. True value is found when a comparison is shown.
So we have to compare the price to its history's track, checking that PE river before we look back.
Right. And if the stock sits near the river's lowest trend,
A bargain might be what the analysis will send.
it might. But you have to be aware the traps in cyclical so great. Or high profits occur just before a terrible fate.
So when a boom is in progress, the earnings soar high,
Right.
making the key E look deceptively low to the curious eye.
But you're buying the peak.
You're buying the peak where the growth has now passed and the industry's downfall is coming and coming too fast.
The PE calculation is static and, frankly, old. I mean, investors have to look at the whole story that's told.
Yeah.
We must look at earnings that are forward and true to forecast the growth that the future brings through.
Okay, so relying on PE alone is it's quite rough.
It is.
We need partners to tell us if the investment is tough.
So let's upgrade our toolkit with metrics that guide, ensuring the quality of the company inside.
Let's first.
Well, the first is the PEG ratio, a brilliant design.
Ah, yes.
It combines PE with the growth rate's clear sign.
And Peter Lynch taught us if PEG is less than a 1.
Then the valuation's great, and the work is half done.
That makes perfect sense. You're rewarding the firm's speed.
Exactly, showing that value aligns with the rate of their deed.
So what's our second companion? It checks power so deep.
It would be ROA and ROE, the promises they keep.
Right. Return on assets, return on equity.
And these measure the effectiveness of the manager's art, ensuring they build value right from the start.
Okay.
They check efficiency, confirming quality's grace, combining the price with performance's pace.
Because without management that distributes profits with might,
Mm-hmm.
the low PE will just linger, staying out of the light.
That's so true. If they refuse to give back the money they seize, the shareholders stay discontented and, well, hard to appease.
So even if the earnings are plentiful and large,
If cash isn't shared, the company just stays at the margin.
it's a smart partnership then for investors so keen.
Yes,
Yeah.
ensuring the earnings power is consistently seen.
That was a great segment on judging a firm's worth. Now, let's talk about risk and its place on this earth.
Oh, shit.
We have to classify our actions to choose what is right, distinguishing styles in the investment light.
So before we even pick the tools, we have to define 3 concepts of play.
Okay.
So you know where your strategy falls every single day.
Right.
Investment demands deep study and patience. A long-term strategy built on solid foundations.
As speculation is quicker, right? It's seeking gains that are brief.
Yeah, but you're betting on timing, causing anxiety and grief.
It still requires research to make the swift move.
It does.
Though the holding period shortens what you're trying to prove.
And gambling. Well, gambling, however, is random and purely of chance.
Lacking any research.
Lacking any research, a desperate dance.
Yeah.
It's based only on luck. which is rarely a friend.
So your capital often approaches its end.
Now that we know where our heart truly lies, let's compare financial instruments under our eyes.
Let's do it. We've got funds, stocks, and futures. What paths can they chart?
Finding the structure that fits where you start. So funds are often stable, quite conservative and low, but even they can turn depressive and slow.
Right. And stocks offer volatility with ups and sharp downs.
But they can reverse the trend if the business is sound.
Then you've got futures, which promise profit with capital so low,
Leverage.
letting you leverage the cash that you show. This allows rapid gains, a thrilling fast ride.
But, and this is a big but, forgetting to close means your margin must hide.
Right, the margin call.
That margin requirement must always be met, or all of your capital is quickly upset.
So you need discipline and vigilance, checking the screen.
And ensuring that closing is perfectly keen.
But this is where our sources deliver a bit of a shock.
Yeah, this part was interesting.
Showing experts don't agree on what stands on the block. Some say mutual funds are the worst choice to make.
Yeah, being slow and costly, for goodness sake.
Really?
This view cites high fees and slow liquidation speed, making a fast market response, impossible indeed.
So they say futures are better.
They say futures are better, with liquidity's true speed, a conflicting opinion that definitely plants a new seed.
So some find futures safer because of the quick trade.
That's the argument, allowing responses before the next big wave is made,
They avoid the slow fund structure that holds your release.
giving you power to react with more ease.
But that choice is for you. We just highlight the view
That's right.
that instruments differ in the risks they accrue.
You just have to remember the trio that must be defined well.
Risk, return, and liquidity.
Story they tell.
That framework helps us choose where our money must rest, ensuring our portfolio passes the test. Okay, let's transition to the tax maze's strange art.
Let's do it. Analyzing the structure right from the start.
It seems like navigating fund tax is surprisingly complex.
Oh, it is. It depends on where the fund lands and reflects. We classify funds by where they are born.
Domestic versus foreign.
Domestic versus foreign, from the night till the morn.
Then we categorize by the region they chase.
Right. Be it domestic or foreign, which sets the pace.
So the system creates 4 paths, a matrix so wide.
Defining the tax rules where your profits will ride.
Oh, okay.
And the 2 types of profit must always be clear. Distribution yield versus capital gain, year after year.
Distribution is cash received on the date.
While capital gain is the selling price's fate.
Now, for domestic funds, the rule is quite keen.
This is a big one.
Capital gains in Taiwan are completely unseen.
Not taxed.
A massive advantage since 2016, making the path for some profits serene.
And this exemption applies whether the fund buys near or far, giving a clear tax benefit like a shining bright star.
So if you seek lower tax, heed this simple decree.
Choose accumulation funds and set your profits free.
Because accumulation funds keep profits and reinvest,
Right.
growing the base and putting your cash to the test.
So the profits stay internal. They're not distributed as yield.
Meaning the capital gains exemption is sealed.
Now, we do have to mention the rule for foreign income, which is high.
How high?
$7.5 million TWD is the amount that they apply. This limit is part of the basic tax we define, where domestic and overseas income combine.
But wait, here's a trap that complicates plans for the wise.
It does.
Distributions and losses cannot offset, causing a surprise.
So if your fund has dropped capital due to market dismay,
Yeah,
the dividend cash still owes tax on that day.
you can't use the loss to shrink the dividend amount.
Nope. Which is a rule that investors must surely account.
So even if your total portfolio value is down,
The distributed income still requires a crown of tax to be worn year after year, from dusk till the morn,
wow. Okay, now let's look at SIPF, the safety structure so near.
protecting the client when a broker disappears,
This system is crucial, a network of aid.
covering clients when a firm has decayed. SIPF stands for the Securities and Futures Institute's protective role,
And what's that role?
protecting your assets, making the investor whole. If a broker defaults due to financial distress and deep lack,
The fund steps in swiftly to minimize the attack.
this system ensures cash is available to pay, ensuring market trust on any given day.
But the protection has limits. A strict ceiling is known.
Yes, a maximum paid per person, the seed that is sown. The cap for the individual is TWD 1 million.
The sum is civilian.
The sum is civilian, protecting the citizen. That's the max payout, ensuring fairness for all. Now compare this to the U.S.
Answering the call. Exactly.
The U.S. SIPC offers broader protection. You see $500,000 total, covering all assets wild and free.
That's a big difference.
And $250,000 cash maximum is the plan, a sizable safety cushion for any man.
But the Madoff case proved protection has its bounds.
Right.
It doesn't cover market loss on unstable grounds.
But what does it cover?
It covers fraud and unauthorized trade that is keen, but not the bad choices the investor has been.
So if the stock you chose sinks due to a poor trend,
The SIPF won't help you. That risk you must fend.
it only covers the theft or the broker's demise.
Not the poor fundamental decision that blinds your eyes. You have to own the volatility and risk that is priced. The protection is for the system.
Not for when you get diced by the market.
Wow. We have charted the metrics and found every detail, putting key knowledge inside your mail.
I think so.
From PE's quick emotion to tax laws we've raced, ensuring your time here was certainly not wasted.
And we've shown that risk tolerance needs clear understanding, keeping your financial ship safely landing.
So true.
Now that you know risk is never quite complete, maybe ponder this thought before you retreat.
Since bank deposits, the lowest risk factor seem, is not investing the true value screen.
That's the question.
When inflation eats cash in a steady descent, does saving mean losing? By total consent.
You just have to assess the purchasing power that you lose, and then decide the path for the wealth you will choose.